Have you ever stopped to think about what a whole country's economic crisis could teach you about your own bank account? Well, today we're going to dig into Japan's lost decades. But this isn't just some boring history lesson. Nope, we're treating it like a super practical guide for your own money. So let's see what we can learn.
I want you to picture this for a second. 1 minute, the economy is absolutely on fire, property values are shooting through the roof, and it feels like the good times are never going to end. And then, the music just stops. For Japan in the early 90s, this wasn't some minor slowdown. It was a catastrophic collapse of asset prices that pretty much wiped out fortunes overnight.
And that really is the big question for us today, isn't it? Because the exact same forces that brought a global economic superpower to its knees, well, they can creep into our own financial lives, just on a much smaller scale. The lessons that Japan had to learn the hard way, they apply directly to how you and I should be managing our debt, our savings, and our investments. Okay, so to get to the lessons, we first need to understand what actually went wrong. We have to diagnose the problem. What happened to Japan wasn't your typical recession. It had a very specific name and a very specific cause, and that is the key to unlocking everything else.
And here's the diagnosis: a balance sheet recession. It's a term coined by the economist Richard Koo, and it describes this really weird situation where all of a sudden, people and companies completely stop trying to make more money, and instead, they pour all their energy into just paying off the debt they already have. I mean, even with interest rates at practically zero, nobody wanted to borrow or spend a dime.
You can think of it like a domino effect. First, the bubble. In this case, stocks and real estate, it bursts. Then balance sheets are just shattered. That super valuable asset you owned is now worth way less than the loan you took out to buy it. And that kicks off this massive, panic-driven rush to pay down debt. And of course, since nobody is spending or investing, the entire economy just grinds to a halt. And all of this brings us to our very first, and maybe the most important personal lesson here. It's all about understanding the incredibly dangerous illusion of paper wealth.
So let's really think about the difference. Paper wealth, that's the number you see on your brokerage statement, or what Zillow says your house is worth. It's totally based on a price that can swing wildly up and down. But cash flow health, that's the actual money coming into your bank account from your job or your business. It's steady, it's reliable, and frankly, it's what pays the bills. Japan, as a nation, bet the entire farm on paper wealth.
And here's where it gets so dangerous. Just imagine an asset you own, one you borrowed money against, suddenly drops 60% in value. Poof! Just like that, your equity is gone. You now owe more money than the thing is even worth. This is exactly the nightmare that happened to millions of people in Japan, turning regular homeowners and solid corporations into desperate debtors seemingly overnight.
So, the bottom line for you is this: your real financial strength isn't the speculative price of your investments, it's your ability to pay your bills every single month from the income you earn. If you focus on keeping your debt manageable compared to what you bring in, you're building a foundation that can actually survive a market crash.
All right, on to our second lesson. And this one uncovers a really strange paradox. See, after the crash, the Japanese people did something that seemed completely logical at the time, but it ended up trapping their economy for years.
Just think about this for a second. Interest rates were basically zero, so you earn almost nothing by keeping your money in a bank account. Logically, you'd think people would be investing their money, right? Trying to get some kind of return. But as the economist Paul Krugman pointed out, they did the exact opposite. Savings rates stayed high. And the reason? It was pure, unadulterated fear.
Now, for any single person who's worried about their future, hoarding cash feels like the safest, most rational thing to do. I get it. But when an entire country does it at the same time, nobody's investing, nobody's spending, and the economy has no fuel to recover. This collective fear basically created a self-fulfilling prophecy of total stagnation. So the takeaway for us is all about finding the right balance. Yes, absolutely, build a rock-solid emergency fund. That cash is your shield, it's your defense. But once that shield is in place, you have to put your other capital to work. Letting fear keep all your money sitting on the sidelines just means you're bleeding purchasing power to inflation year after year. Okay, our final lesson. This one reveals a really surprising strength that actually helped Japan avoid a complete and total meltdown, and it translates into a powerful principle for our own finances. It all comes down to self-reliance. You see, despite having this enormous national debt, Japan had a secret weapon.
A whopping 90% of its government debt was owned by its own citizens and its own institutions. The country, in a way, owed money to itself. And what that meant was foreign creditors couldn't just get spooked, pull the plug, and trigger an even bigger crisis. They were insulated.
Now, this leads to a really fascinating question for us personally. If a whole nation can be its own creditor, how can you do the same thing in your own life? How can you, in a sense, owe money to your future self instead of to a bank?
Well, the answer is by building a really high savings rate. Think about it. When you want to buy a car or go on vacation or fund your retirement, you can draw from your own savings instead of having to go get a high-interest loan. You literally become your own bank. And that kind of self-reliance makes you incredibly resilient to things like interest rate hikes and economic shocks.
So let's bring it all together. When you look at these three lessons, the danger of paper wealth, the trap of fear, and the power of self-reliance, a single, really clear theme starts to emerge. It's all about building a financial life that's based on prudence, not on wild speculation.
You know, there's an old saying that just captures this perfectly. Debt is a powerful tool, but it's a terrible master. Used wisely, yeah, it can help you build wealth, like with a sensible mortgage. But letting it control you, letting it become your master, that is a recipe for disaster.
And that really leaves us with one final question to ask ourselves. And I mean really ask. Take a hard look at your own finances. Is your foundation built on the shaky ground of just hoping and praying that prices keep going up forever? Or is it built on the solid rock of strong cash flow and a deep, deep respect for the difference between price and value? Japan's story proves that the prudent path, that's the only one that truly lasts.